In today's fast-paced world, it's easy to overlook the complex systems that shape our daily lives. But what if we told you that one of the most fundamental of these systems is often completely misunderstood? Today, we're taking a closer look at the intricate world of banking to unveil how banks truly make their money. You might think banks simply act as secure vaults for your cash. The common misconception is that they just hold on to your deposits. The reality is that banks are masters of leverage and financial engineering, and we're about to break down exactly how they turn your deposits into profit. The most fundamental way banks generate revenue is through interest rate spreads. Think of it this way: when you deposit money into a savings account, the bank pays you a small amount of interest. They then take that deposited money and lend it out to other customers in the form of mortgages, car loans or business loans, but at a much higher interest rate. The difference, or spread, between the interest they pay to depositors and the interest they earn from borrowers is their primary source of profit. It's a simple concept that forms the bedrock of traditional banking. Of course, that's not their only revenue stream. Banks also profit significantly from a wide array of fees and charges. You've likely encountered some of these yourself, such as ATM fees for using another bank's machine, overdraft fees for spending more than you have, or late payment fees on your credit card. Many accounts also come with monthly maintenance fees unless you meet certain criteria. While each individual fee may seem small, when multiplied across millions of customers, they add up to a substantial portion of a bank's income. Beyond everyday customer interactions, banks are major players in the global financial markets. Through their investment banking divisions, they facilitate mergers and acquisitions, underwrite stock and bond offerings for corporations, and manage assets for wealthy clients, earning hefty commissions in the process. Many also engage in proprietary trading, where they use their own capital to buy and sell stocks, bonds, and other financial instruments, hoping to profit directly from market fluctuations, which is rooted in the concept of fractional reserve banking. When you deposit money, the bank is only required to keep a small fraction of it on hand. The rest can be loaned out. When that loan is made, it gets deposited into another account, creating new money in the system that can then be loaned out again. This process effectively multiplies the initial deposit, allowing banks to create credit and earn interest on money that, in a sense, they created out of thin air. To stay profitable in a changing world, banks must constantly evolve. This means embracing financial innovation, from developing user-friendly digital banking apps to partnering with fintech companies to offer new, cutting-edge services. At the same time, they must be experts in risk management. Lending and investing are inherently risky, so banks employ sophisticated strategies like diversification and hedging to protect themselves from potential losses, all while navigating a complex web of government regulations designed to keep the financial system stable. A bank's profitability is a multifaceted engine. They are not just passive keepers of cash, but active participants that play a vital and often controversial role in lubricating the gears of our entire economy. And that's a wrap on our exploration of how banks make money. We hope this has given you a clearer picture of this intricate subject. Thanks for watching, and be sure to join us next time as we dive into another fascinating topic.